Welcome to our Ask an Expert show, where I invite a fellow professional in the US-UK cross-border space to come in and talk to me about the issues we think Brits in America need to be aware of if they are going to thrive here. My guest today is the returning champ and raconteur, Mr. Aidan Grant, partner in the tax and trust estate planning team at Collyer Bristow in the UK, who, as for those watching on YouTube can surely tell, is here with me live and in the flesh as he is visiting clients and business partners in New York and Boston this week, which presented the perfect opportunity for us to meet up in real life for the first time and record a podcast for you fine folk. So, for those inclined, you can go back and find Aidan on episodes 26, 28, and then 43, when he had to come back and update us after the UK changed the domicile rules after only 250 years. And this time we're going to focus our conversation on the UK residency rules, which are important for anyone looking to either return to the UK full-time, or even more relevantly, I think, spend any significant time there working and or in retirement. So, without further ado, let's get into this. Hi, Aidan. Welcome back to We're the Brits in America.
I mean, I couldn't not come and see you, could I, Richard?
No. Well, listen, I hoped to be the highlight of your trip, but I saw yesterday you were at Cipriani downtown, so I know that's going to be hard to beat.
Well, look, we don't know what's going to happen in this hour. Everything is possible.
Sprinkle the magic. So, listen, people can go back and find you. Hopefully, regular listeners are thoroughly familiar with you now, but just tell us who you are.
Sure. So I'm a UK tax and estate planning, a partner at Collyer Bristow. You were kind enough to mention the firm. We are a 250, 300-year-old law firm in the UK, and I specialise in international tax and estate planning for usually US-connected individuals.
250, 300-year-old law firm. Are you really?
Yeah, we are. It's once you go back a certain length of time, it's kind of hard to know what counts as a law firm because it was just men operating in business together. But one of our sort of amateur archivist colleagues discovered an extra sort of 50 years that make us that bit older. But, it's our prerogative to say we're that old.
I do love that. Yeah, I do miss that about the UK, these ridiculously old organisations and old everything.
I don't know what business was like back then, but I don't suspect they were doing video podcasts back then.
No. That's a relatively recent development. Okay, right, so let's get straight into it. UK residency, what are we here to talk about?
You and I had discussed previously that one of the areas that we hadn't discussed across our many episodes was the individual who is maybe thinking of retiring back to the UK, and you had sort of thrown out the question of, well, what if they spend some time in the UK? What if they maybe own a property in the UK? What if they're looking to split their time between the two countries? And what are some of the ways they should think about that presence in the UK affecting their tax exposure? When I came on last time, I updated you on the UK tax rules that came into effect on April 6th, which have radically changed the UK tax system for those who'd spent significant time outside the UK now looking to come back. And we are now in effectively a pure residency-based system. And so whether you are tax resident or not becomes really the key linchpin as to your extent of UK tax exposure. Mm-hmm. And so I thought it was important for us to come on and spend a bit more time talking about what it actually means to be a UK tax resident and that all-important question of how many days can you spend in the UK before you will trigger those all-important rules.
Yeah. And I think this is important for two reasons. Now, first of all, is the clients who are going to go back. So I'd like to talk about clients going back. Do they just leave the US, head to the UK, don't think about dates, or should there be some planning over when they leave the US, when they arrive in the UK? And is it worth them considering maybe trying to spend some time in neither jurisdiction, trying to have a no tax residency for a period of time? Because then does that create an opportunity to do some transactions to minimise taxes? And then the important one I think I come across even more often is client retires, they've got kids, grandkids in the UK, maybe they've got a house in the UK, and they're like, I want to spend 6 months UK, 6 months US. And they haven't given any thought to tax ramifications. Yeah.
So I think the thing that's important to say first is planning before you move hasn't disappeared. I think it is still important for people to take advice before they enact a plan, because the UK tax rules that have been in effect since April 6th, whilst changing the landscape quite considerably and maybe sort of taking some of the pressure off doing some pre-arrival planning, there are nevertheless some things that you will want to have thought about if you are thinking of spending enough time in the UK to trigger residency status. And I'll say at the upfront here, if you're going to be spending more than 6 months of the year in the UK, you are going to be triggering our tax residency rules. If you are going to be spending fewer than a couple of months in the UK, you are probably not going to be triggering our tax residency rules. So the people that we are really concerned about when we are talking about are you going to be a resident for tax purposes or not, are those people that spend between 2 and 6 months of the year in the UK. What is still important to say is the UK operates tax residency, like most things, tax-related on a tax year basis. So in the UK, our tax year runs from April 6th one year to April 5th the next year. And if you are thinking of coming to the UK and you end up triggering our tax residency rules, you will trigger them for an entire tax year. So even if you only come to the UK a couple of months into the tax year, say on June 1st, we would by default backdate your residency to April 6th.
Sorry, why this is relevant is if I do something, I'm in America, and I do something at the end of April, a transaction at the end of April, thinking I'm in America, like it's just, I only have to worry about America. I then move to the UK in June, I become a UK resident later in the year, suddenly they're going to look back to that April transaction.
Subject to things we might talk about later, certain express reliefs that you might try and claim. But by default, if you don't actively claim those reliefs, the UK will tax you as a resident for the entire year from April 6th. And so what we always say to clients is, for those thinking about planning before they move, before we start to think about what the consequences actually are, but for those thinking of planning before they move, we want you to have completed that planning ideally by the April 5th prior to you moving, because that means you will have completed your tax planning in the year prior to your arrival. And that's just going to be more efficient for almost all purposes. So notwithstanding everything I say from this point onwards, the general rule is still going to be start and complete your planning, having spoken to the right tax advisor in the UK, complete that planning by April 5th.
Flip side to that, I mean, the theme here, folks, as ever, if you listen to this podcast or any of our podcasts, is plan, plan, plan. Please do planning. But the flip side to that, I guess, would be if I expatriate from the US, let's say in March or February, so I'm definitely not going to have enough time to build up to become an automatic UK tax resident in the UK before April the 5th. Mm-hmm. Would I then... I could be in the UK but not be a tax resident for the end of that year?
In all likelihood, you probably won't be. It is theoretically possible, and I can devise you a fact pattern where it exists that your presence in the UK for even a single day could make you a UK tax resident for that entire tax year, backdated 364 days. It's very unlikely. But the rules that we have in the UK, known as the Statutory residency test, are a black and white objective set of rules. If you give me a perfect fact pattern, I can give you with exact specificity an answer, will you be tax resident for that year? Unlike, say, our old-fashioned domicile rules, which were very wibbly-wobbly and sort of subjective in nature. In practice, if you come to the UK and you spend only a few weeks here, or a month, maybe a couple of months here, for most people, that won't be sufficient to trigger tax residency status. So in your scenario, if you come in, say, early March, you probably aren't going to be tax resident for that remaining bit of that year. You probably will only start to be resident for tax purposes from the April 6th follow.
Am I oversimplifying this, or is it a rule of thumb that in general, without knowing anything else, it's better for people to leave the US and return to the UK in that Q1 window?
Yes, I think that's probably right. There's two different ways to think about it. One is from a kind of tax crediting perspective, and I know you've spoken to UK tax advisors, UK accountants before about this point. The way in which the US and the UK credit each other's taxes is a little precarious because of the fact that our taxes don't line up, and so there are sometimes things you want to be doing in Q1 in the US tax year that align with the previous UK tax year, and sometimes you want to be doing things in Q2, 3 or 4 so that they arrive in the next tax year. But yes, as a general rule, from a UK perspective, we don't mind you coming in Q1 because you're probably not going to trigger tax resident status, particularly if you come towards the latter end of Q1. But of course, the flip side is, by coming in Q1, does that mean you've spent, say, 2 months of the year in the US already? Will that have had a consequence for you for US tax purposes? Now, if you're a US citizen, and thus you're always going to be taxed on a worldwide basis in the US, it probably doesn't matter quite so much. But if you weren't a US citizen, you were on a visa of some description where your presence in the US was enough to trigger tax residency status in the US, then you leaving in March might trigger an additional year of filing in the US, as opposed to maybe having left in December, and to the point that you made previously, perhaps spending a night, go round the wrong way round, go the long way round on a nice vacation, and then come to the UK in March or April. You can probably avoid becoming US tax resident in that Q1 if you plan carefully, but not become UK tax resident until the start of our tax year on April 6th.
And in that, let's just say that the 3 months you're traveling the wrong way around the world, can you do stuff? You're not going to be a tax resident in the US. You're not going to be a tax resident in the UK. You're not going to be a tax resident anywhere.
In theory, let's assume you're right.
Yeah. Can you withdraw pensions and IRAs and all this other stuff, maybe convert to Roths and with no tax consequences?
So, yes, in theory, there are various anti-avoidance rules in the UK that might catch you avoiding tax in years when you were non-resident, depending on how long you've been outside the UK for. But let's assume, for the sake of argument, that you've been outside the UK for
5 years or something, isn't
Correct,
it?
yeah. Let's assume you've been outside the UK for sort of 20, 30 years and you're retiring back to the UK. Then yes, in practice, because you've not yet become a tax resident, anything you're doing with respect to your non-UK wealth is not going to trouble the UK taxman. The reason why that is less important, and I referenced this earlier, the reason why that kind of pre-arrival planning or that kind of going around the world the wrong way planning is perhaps slightly less impactful these days is because for that person who's coming back to the UK having spent at least 10 years out of the UK, they'll have access to this new 4-year foreign income and gain regime that I talked about on the last episode, where the UK, where you as a tax resident have the option not to pay UK tax on your foreign sourced income and gains anyway. And so for a lot of the income and gains that you might realise during that non-resident period that you mentioned, well, if you realise them in the UK, in respect of your foreign wealth, you could probably avoid UK tax on those funds anyway. In respect of UK assets, yes, you're always going to pay UK tax on them. But if you were, say, selling a valuable UK business, you wouldn't want to ideally sell that UK business when you were in the UK because that would trigger a capital gains tax charge. You probably don't want to sell that business if you were a US tax resident in the tax year in which you were a resident in the US. But if you could sell that business in the intervening period where you're a resident in neither place and thus exposed to income tax, capital gains tax in both jurisdictions, or in neither jurisdiction, then yes, there can be some value doing that. This is one of those reasons why we don't want prospective clients or existing clients to come back to us in February or March in advance of their arrival in the UK in April. We want them to come in September, October when we've still got time to plan.
You touched on something else that I think is an often misunderstood complexity of moving back, and that's kind of unrelated to what we're talking about, but that's the tax years not aligning. Mm-hmm. That people think, do you know what, so I'm going to have to do US tax returns, so what? And they don't realise just these two systems don't align perfectly. And that is, it costs money and it's complicated.
Correct. I mean, in one word, yes, there is a very good network industry of people in the UK who specialise in helping Americans from a tax filing perspective. I know that you've spoken to someone on this podcast previously, and whilst I know enough to be dangerous to point people in the right direction, there are those specialists who are...
These aren't cheap. They should be used to paying for quality tax preparation, but I find a lot of the people we speak to are regular folk, where $4-5 a year tax preparation is a fairly hefty sum, especially in retirement. Yeah. These costs add up.
There are people, and I don't want to speak for these people or misrepresent their business models, but there are people in the UK who specialise in helping what I would refer to as an everyday American, someone who either isn't or at least doesn't consider themselves sufficiently wealthy to need that level of tax advisory service, and what they really want is a kind of execution only. Just need a simple US tax return. I need to claim a credit for a tax paid in the UK. Maybe I'm taking pension or IRA withdrawals, and I just need my tax returns to align and the tax to be paid at the right time. I don't need anything more fancy than that. There are people in the UK that will help and align their business model with those people. It's not to say that's not without cost, but the industry is growing.
There's always going to be a premium because you're not paying for US, you're not paying for UK, you're not paying for just US, you're not paying for just UK, you're paying for US, UK, and the interaction between the two. That is highly specialised and highly valuable, and there's always going to be a premium for that.
But I'm going to pinch your own expression from you. It's always better to prepare than repair. And the cost of getting this wrong and the cost of having potentially paid tax twice or having to then deal with the IRS or HMRC having not done it properly the first time is going to always be more expensive than having just done it.
100%. So listen, you're gonna have to give me some names after this because I know I know a lot of the good firms that we're talking about who are fantastic. They've been on this podcast. They'll come on this podcast in future, but I also need to know who can help the more regular folk, who need special advice but don't necessarily need the resources and expertise that these big firms bring to bear, and they really do. They are shit hot. Right, so anyway, back to residency. Where were we?
So I think we've sort of danced around a lot of the issues, but I think the key issue that has to be addressed is what will be the factors that cause someone to be a UK tax resident or not. And it's important to stress at the beginning that what we are talking about here is tax residency status. We are not talking about any other form of residency status, like, for example, immigration status. If someone's a returning Brit, they're a UK citizen, this is going to be a moot point.
Yeah.
But if they are coming to the UK, maybe they are coming as the spouses of a UK resident, of a UK citizen, or they're coming to the UK for the first time, you need to have sorted out your visa status entirely separate to this. These two things do not interact. There will be sometimes rules that say you have to spend X amount of days in the UK to satisfy your visa requirements, but we might say those number of days might make you a tax resident or not. So it is certainly possible for you to be legally resident here from an immigration perspective, but not be tax resident. And it is similarly possible for you to be a tax resident, but be in the UK illegally for immigration purposes.
Oh, wow. Okay.
There's some funny case law from the Second World War about some of these things. But we're just going to focus on tax.
Wait, from the Second World War? Why? Because
about refugees coming to the UK, people coming over on boats, people coming here and having no right to be here. HMRC still thought it was appropriate to tax those people, notwithstanding they'd fled war-torn Europe.
How very IRS of them.
I know. Another day I'll tell you all about it. So the UK, I mentioned previously, has this test known as the Statutory Residency Test, or the SRT. You will often hear people refer to it as the SRT. The way the SRT works is on a series of tests, and you go through these tests in order, and if at any point you satisfy one of these tests, the test ends and you're a tax resident. If you don't satisfy that test, you move to the next rung, and so on and so forth. And the tests really come in two forms. The first set of tests are known as the automatic tests, so called because if you trigger one of these rules, you are either automatically resident or you're automatically not resident, and we don't have to think about anything else. Usually when people are talking about our tax residency rules, they're not talking about those tests. I will come back to them, but what they're usually referring to is the second limb of the test, known as the sufficient ties test, which is a series of calculations you make that say with X number of connecting factors to the UK, known as ties, you can spend Y number of days present in the UK before you trigger tax residency status. And with the ties going up, the days go down, and vice versa. Just to cover off the automatic rules first, there are a couple, and they generally relate to either spending sufficiently enough or not enough days in the UK at either end of the spectrum. So 6 months and a day in the UK will make you a tax resident. Depending on whether you've been tax resident previously, it's 16 or 45 days or fewer, and you won't be a tax resident. But between those two bounds is where the rest of the time we play. There are ones relating to whether you start to have a home in the UK. Sorry, you have a home in the UK at which you spend a certain amount of time, and you don't spend time overseas. If you start to work full time in the UK, if you work full time overseas, etc. There are these various rules, and it is worth not forgetting about them, because if you come to work full time in the UK, that is, for example, one of the tests where you can be resident even though you've only been in the UK for 1 year. For 1 day.
That's just an automatic trigger.
If you, in theory, started working in the UK at the end of March, at a new job that started, say, on the 30th of March, and you then worked full-time in the UK for the corresponding year, subject to satisfying a few other criteria, you could, in theory, trigger tax residency status in that year in which you only spent a few days, because in that year, you started working.
Oh, yeah. I can see how that could happen.
This is not what usually catches most people. Usually, it's the sufficient ties test. Uh-huh. The sufficient ties test has, for those coming to the UK, 4 ties. And whether you have 0, 1, 2, 3, or 4 ties determines whether you can spend 182 6 months of the year, 120, 90, 45, etc., and it comes down. The connecting ties are accommodation, whether you have accommodation available to you, either that you own or that someone else owns, and depending on whether you own it or someone else owns it, how many nights of the year you can spend there will trigger an accommodation tie. Whether you have a spouse...
Wait, so just renting an Airbnb?
Renting an Airbnb, likely not. If you rented an Airbnb for sort of 6 months, the UK would probably say on a facts and circumstances test that is accommodation.
Really? Even though purely renting it?
Yeah, and purely renting, period, in the UK would count as accommodation. There is a series of tests you can use to determine whether something counts as accommodation. But if you own a home in the UK, that's going to be accommodation, let's put it that way. If you're staying at your son's house or your daughter's house or your parents' house, that's going to be accommodation. Whether you have a spouse or a minor child who is independently UK resident of you, that is a tie. That's called the family tie.
Also, if you have a house or you have access to a house, including a long-term rental, and you have these are very likely going to be the case, because I'm thinking of specific clients who are going back because they've got a kid and a grandkid. Would that be 2 ties?
Minor child. Not adult child. Oh. So a spouse or a minor child.
Okay, not a minor grandchild. Okay.
But yes, if your husband or wife and your minor child were in the UK, and they lived at a home, and you were overseas working, you will automatically have 2 ties.
Okay, yeah.
The third and the fourth tie. The third tie is what we refer to as our work tie. So are you working in the UK?
What about if you're working remotely?
Work in the UK counts as work physically carried out in the UK. So if you're working remotely in the UK for a US company, you are working in the UK.
Now I could see that happening.
This happens increasingly frequently, and the work tie is one of the ones that we talk to people about most frequently, I find, in my experience. You have a work tie.
And do people think, oh, no, Aidan, it's okay, I'm going to work I'll be working remotely?
Very frequently.
Yeah.
You have a work tie if you spend more than 40 days of the year working physically present in the UK, and a day of work is if you spent more than 3 hours of the day working. That's easy for an attorney because I know how much time I spend because we have to carefully log all our time. But imagine you're an artist. What counts as work for an artist? I mean, physically painting or drawing, sure. Visiting your studio, maybe. But networking, pitching for new work, some of the more creative business development aspects to it, does that count as work? It can get quite tricky sometimes. But in theory, the test is black and white. 3 hours a day, 40 days in the year, you have a work tie. The final tie is known as the 90-day tie, which is the one that sometimes trips people up, which is, have you spent more than 90 days physically present in the UK in either of the 2 previous tax years to the one on which you're doing the calculation, notwithstanding whether that time in the UK was enough to make you a tax resident or not. Because you could, in theory, have a 120-day maximum day count in a tax year, and you spent 100 days in the UK. That didn't trigger tax residency status. But in the next year, you now have a 90-day tie, because in the previous year, you spent more than 90 days here.
Okay, so just the act of being here can then reduce the time you can spend here in future years.
Exactly.
So there's no hard and fast rule like, okay, we've done this exercise and right now we calculate you can spend 120 days here without triggering. That's only valid for 1 year, because next year that's going to change because you've got this extra tie because of that time spent here.
Can I make it one step more complicated than that as well? So you go through all of those ties. If you have 0 connections to the UK, you can spend 6 months of the year here, 182 days before you trigger tax residency status. If you have 1 tie, you can also spend 182 days of the year here. 2 ties, 120, 3 ties, 90, 4 ties, 45.
4 ties, 45 days.
But that means, don't forget, you've got accommodation here that you use, you've got a spouse or a minor child that's resident here, you're working here, and you spend 90 days.
I mean, you're a resident.
In the UK. So 45 days. I mean, we don't usually get down to that amount because people realise that they've got there already. Those are the limits for people who have not been resident in the previous 3 tax years. Once you've been resident once, then the next year, all of those day counts, in effect, shift down 1.
Wait. Let me. Sorry. Once you become a resident, once you've crossed the threshold, you're a tax resident this year.
The next year, those same number of ties, you can now only spend fewer days in the UK. So in year 1, if I said you had 1 tie, you could spend 182 days in the UK. Next year, that 1 tie means you can only spend 120 days in the UK. So they make it harder to leave the UK than arrive.
If I've successfully remained under the threshold, and I've remained under the, and I don't, I always remain under the threshold. The dates kind of stay the same. But if I 1 year inadvertently, maybe I get ill. Maybe I spend time in hospital.
We'll come on to that.
And I inadvertently trigger and become a tax residency. Suddenly, I need to rethink the whole thing for future years.
What we would usually do in advising someone before coming back to the UK is we would say, okay, well, in year one, we assess you've got this many ties. So in year one, you can spend this many days in the UK. The moment you flip the threshold, the next year, you'll be able to spend Y number of days. Bear in mind, that 90-day tie, you might have only had 2 ties, a accommodation tie and a work tie in year one, but you spent 110 days in the UK, which would have been fine. But then in year 2, you've picked up a 90-day tie. So now you can only spend fewer days in the UK because you were spending 90 days in the previous year. The statutory residency test is not straightforward, but it is black and white.
Yeah, which is good.
This is the thing that's important about it. So this is why we say to clients, if you can come with perfect facts, and that does sometimes mean me saying to you, going back several years, how many days did you spend in the UK? And they say, well, how do I calculate that? The answer is, well, you've got to look at your flight details, or you've got to look at your days that you rented a hotel. You need to give me the number of days. I can tell you whether you are tax resident or not. But it is not a simple test, but it is black and white.
Don't you think so much of what we do, certainly what we do, is simple, but it's not easy?
I think, yes, a lot of it is simple but not easy. I think people get surprised as to how much grey there is in tax law. They think, well, and this was the case with domicile rules for many years. People say to me, how can you run a tax system for a country as large and an economy as developed as the UK? How can this tax rule have this much grey in it? How can it not be clear, either I get taxed or I don't get taxed, surely? And that is, from my perspective, often what people complain about more frequently. This test is simple if you know how to run the test, but that's a bit like saying, I can run an algebraic equation because I know how to run an algebraic equation. It's simple to that person, but it looks like gobbledygook to someone else. You mentioned, what if I get ill? There are a couple of extenuating circumstances that you can bring to bear if you think you're going to trigger the rules, or looking back, you think you have triggered the rules. And I want to mention 2 of them. One is what we call exceptional circumstances. So if you've been in the UK for X number of days, but of those days, they were outside of your control being here, we can afford that individual, fairly certain it's 60 days, up to 60 days, under exceptional circumstances that won't count towards the resident.
So it's like literally someone's in a coma.
The law is defined very narrowly. There have been a couple of case laws recently that have actually sought to widen it slightly, but we always say to clients, do not rely on that. Needing to be in the UK and then your flight gets delayed would not qualify. Breaking your leg and being in hospital may well not qualify. Being in a coma probably would qualify, because there is literally nothing you can do about it at that point.
Breaking your leg and being in hospital, that's interesting.
You would have to make the claim to HMRC, but historically HMRC has not looked very favourably on people.
So if you're really playing it to the if you're going right up against the line, that's a real risk.
We always say to people, don't.
Yeah.
Play with a buffer, because you don't know what's going to happen. So if I say to you that your maximum day count in the UK is 90 days, don't budget spending more than 85, 86 days.
Yeah.
A day is a day, by default, spent in the UK at midnight. So if you come and land in the UK at 11 p.m. off the plane from JFK on a day flight, you've only been in the UK for an hour, that counts as a day spent in the UK.
Yeah.
Conversely, if you spend 23 hours in the UK and then took off for JFK at 2300 hours, I don't believe that flight's available, but let's say it was, then that wouldn't be a day spent in the UK because you weren't here at midnight. So you do have to be very, very careful, because it's very easy to add a couple of days or lose a couple of days accidentally, or be stuck here because, in the US it snows, maybe in the UK it rains too hard or something, and then your flight gets delayed.
Oh, anything can happen.
Anything can happen.
In a car accident on your way to the airport.
So, number one, there is this thing called exceptional circumstances, but it is viewed very narrowly by HMRC. The second one, and the one that we probably talk to clients more frequently about, is what's known as split year relief, which is a relief that allows an individual who comes to the UK partway through the year to elect to be treated as tax resident only from the point at which they trigger one of the various rules under the split year tests. So that client I mentioned hypothetically to you previously, who say comes in June, by default would be taxed from 6th April. If they can qualify for one of the split year tests, they can be treated as non-resident for the first 2 months of the year and only be treated as tax resident from the day on which they trigger the split year test. And those tests are, again, things like owning a home in the UK, starting to own a home in the UK, starting full-time work in the UK, etc. So if you move back from the US to start a new job in the UK, and let's say you start that job in September because you align it with the school dates for your kids, it should hopefully be possible for you to only be tax resident from, say, the 1st of September, notwithstanding under the default rules, you would have been resident on April 6th.
How would I even go about claiming that?
So residency status is determined and recorded in your tax return.
Wait, so I would do that retrospectively and then hope, fingers crossed, that gets
correct.
accepted.
Well, the split year test, like all tests, they're black and white. They're not simple, but they are clear. And if you start work in the UK on the 1st of September, on a full-time basis, and provided you have not spent too many days in the UK between April 6th and the day you start that job, split year treatment should not be in question, but you've got to know it exists, and your accountant, your tax advisor, has to know to claim it. That's why I say you don't just get it automatically. By default, you would be tax resident from April 6th, but that does mean for most pre-arrival planning, not all of it, because some of the pre-arrival planning really helpfully looks through split year treatment, but for most pre-arrival planning, let's say you want to sell a home in the US and then move to the UK, for most pre-arrival planning, your tax resident status only applies from the day that you trigger that test in, on my example, 1st of September. So that is the one for people looking to move to the UK, because, Richard, not all of my clients pay attention to me when I say if you could move here on April 6th, that would be really convenient. Mostly they come during the summer or to have the kids start in school or at another time of the year.
Starting school is a big one.
Yeah. So that split year treatment can be really important because a lot of people won't have got themselves together enough in October the previous year to have thought about their planning enough to have it completed by April 5th in time for their kids to start school in September. They'll be coming to me in June and saying, what should I be doing? And I say to them, well, in theory, right now, on June 1st, you may well be treated as a tax resident, despite the fact that you're calling me from New York.
Yeah.
Because I don't know whether you're going to trigger the tax rules and be backdated to April 6th.
Oh, wow. You know, when you're doing, real world, when you're doing pre-arrival planning, are you like sitting down with a client and a US tax advisor or attorney, like to say, right, these are the rules in the UK. This is what we're going to try and this is the strategy. But then you want to work with them to understand how and when to dispose of their US stuff.
Mm-hmm. Quite often. So it really depends upon who's the existing team the client has around them. So if the client is thinking of returning to the UK, but they've had the good sense to hire a good and proper financial advisor, let's say, then absolutely, I'd want the financial advisor there, because it's not for me to tell that client whether they should be disposing of their wealth. Number one, I'm not an investment manager, so I'm not going to be giving them that recommendation. Is now the best time to be getting out of that stuff? But also, two, that advisor probably has a longer, well, if they've come to me fresh, they will have a longer relationship with that person and will know more of the facts, more of the background, and will probably be a useful crutch for the client in having, this information kind of thrown at them. And so, yes, absolutely. But a lot of clients don't have that because they consider themselves everyday people. They maybe use an accountant in the US to file their US tax return, but as far as they're concerned, they're just coming home, and I'm maybe the first person they've talked to.
They'll have like 401ks, brokerage accounts, properties. How disposing of them at the right time in the right place could mean the difference between an awful lot of tax. An awful lot of tax.
It absolutely could.
Yeah, interesting. I don't know how people do this without advisors. I know we're heavily biased and we're saying very very unobjective.
Yes.
But knowing what I know, I still don't know how people do it.
No. This is why we do the job we do. This is why we do what we're doing now, because we want to get the good news out there.
The
Got the gospel.
The gospel, yeah. Okay, right, let's change gears slightly then. So, someone has triggered UK residency unwittingly. What does that mean? So I guess I'm a US citizen. Most people we know who are going to go back. Yeah, obviously, people do go back on visas. People do go back and relinquish green cards. They, more than anyone, need planning.
Agreed.
Please, anyone listening to this, please don't leave the US. Well, if you're on a green card without consulting several people.
Do not put your green card in a drawer and forget about it.
Just do not do that. Critically important. But for most people, we're talking about US citizens. Our clients will move here. They'll take US citizenship, and then 20 years later, they'll start spending time in the UK. You're in the UK, you're a US citizen and a Brit, you've inadvertently triggered UK residency.
Yeah.
So what?
So, first thing to say is, if you know you triggered residency status in the UK, then you will need to be reporting that to HMRC. There will be a tax
What do you
return.
mean? Do you mean like writing them a letter, or do you mean like just submitting a tax return?
Excellent clarification. So you will need to file a UK tax return.
Okay.
That means seeking appropriate advice from a UK
What if I
tax
don't?
advisor.
Well, oops. No one knows.
Now we're into HMRC compliance, which is a very different topic. You have an obligation as a taxpayer to self-assess and disclose to the revenue in the UK, like in the US.
Yeah.
If you didn't, that is against the law. HMRC will say that the tax is due when HMRC find out, and HMRC has...
How will they know? But I'm playing this role here. This is not what I believe. I want to know. I'm getting nervous just playing this role.
Because we live in an increasingly interconnected world. The IRS may well know, for example, that you've left the US, and they will be doing their reporting, and their reporting may say, I now live in the UK, and the IRS may share that information with HMRC.
Right.
The US and the UK, as at the date of recording, still enjoy a fairly close relationship, and the IRS and HMRC have an information sharing exercise. So do...
And I will share the acronym that should put the fear of God into anyone who is thinking of not reporting their residency or any income or anything whatsoever, and that is AI. AI, the amount of data these organisations have access to already, and the way they're going to be able to trawl through it with AI should put the fear of God into everyone. Just get compliant people.
Acronym. I thought you were going to say FATCA.
Oh, well, I mean...
But if you combine FATCA and AI...
Now you've just been rude.
Let's not go into FATCA. But, these are some of these reporting standards that mean that these organisations, these tax authorities will share information, as well as you bump into anything else in the UK. You bump into the benefit system, into the NHS, into the criminal justice system. The state, with a capital S, will find out about this, and it is going to be more consequential for you to deal with it post facto than getting that done properly at the time. Yeah. So let's say you know that you've triggered tax residency status. You will need to file a tax return, if nothing else, because you need to report the fact that there is potential tax to be paid. Any of the reliefs that you might want to claim, and I'm going to mention a few of them, you claim on your tax return. You don't get them by default. And so you need to make sure you consult the right person. Let's say, for this purpose, a UK tax advisor, an accountant. So what are the consequences, and how do we maybe ameliorate some of those consequences? I mentioned to you when we last spoke that the UK now has this new UK tax system that has been in place since April 6th. For someone coming to the UK who has spent at least the last 10 years living outside the UK, they have access to a new 4-year foreign income and gain regime from the point at which they first trigger tax residency status. During that 4 years, you can elect or designate, so the rules say, not to pay UK tax on any foreign-sourced income and gains. So if you come to the UK and you accidentally trigger our UK tax rules, and you have, I don't know, property rental income in the US or a US salary or something like that, and you've accidentally triggered our rules, then it should be the case under our new rules, making sure that you file correctly, that in those first few years, you don't actually have to pay UK tax on that wealth.
So wait, as long as I follow the process correctly, which is file a return and make an election, essentially there's no consequence in those first 4 years.
Correct.
Okay, that's great.
I mean, we are, as at time of recording, less than 2 months into our new system, no one's done it. Well, to the best of my knowledge, no one's done any filing yet under this new system. I haven't seen the tax return that it looks like yet. We should do this under. So we're all kind of waiting in expectation and anticipation as to what this actually looks like in practice. But the rules are absolutely clear. You get this 4-year regime, which means, one, some of that pre-arrival planning is maybe slightly less impactful because some of the things you might want to do, you can do while you're in the UK. I mentioned the one example when you and I met previously. If someone is invested heavily in US mutual funds, for example, we might have typically previously told them they might want to divest themselves of those mutual funds before they come to the UK because they are less tax efficient for a UK tax resident. Now they're in the UK, they have this 4-year regime. If they're holding these mutual funds in a regular sort of brokerage account in their own name, etc., and they want to get rid of those mutual funds, they can do so in those first 4 years without triggering the higher UK tax rates that apply on disposals of those interests in those unit funds, in those mutual funds. So that 4-year regime, as a kind of thinking about it from a relief perspective, is a really handy way for someone coming to the UK to either plan to come to the UK and have a lighter UK tax footprint, or as a kind of life raft thrown out to the person who has inadvertently triggered residency status and doesn't realise that they have. As long as you're within that 4-year period, in theory, you have the option to claim no UK tax on that foreign wealth, but you have to claim it. If you don't claim it in a tax return, HMRC will expect UK tax to be paid. Again, whether you pay the tax and you claim a credit in the US or vice versa will depend upon the item in question. But the reliefs are there, but only if you file properly and on time.
I might be getting into the weeds a little bit here, but am I right in thinking, let's say I inadvertently trigger it. I become a UK resident. I'm taking good advice, so I file appropriately and I make the election. Do I now have a window of a further 3 years where I can essentially spend as long as I want in the UK? And because I'm in that 3-year window, no consequences.
You might think about it in those terms. I would say it's certainly the case for some clients that it won't be quite so straightforward because there are, for example, some sources of income and gains from the UK that you don't pay tax on as a non-resident. So I mentioned earlier in this discussion selling your UK business, for example. If you sell your UK business when you're a UK tax resident, you will pay UK capital gains tax. If you are not a resident, you won't pay UK capital gains tax. But if you're a UK tax resident and you're within your 4-year period, the sale of your UK business is not a foreign sourced income or gain, so you can't claim relief for that. So as regards your UK wealth, coming to the UK and being tax resident here can be more consequential. But yes, for your foreign wealth, you effectively are getting a 4-year try before you buy.
Wow. So, but let's say everything was in the US. Pretty much everything was in the US. I could then I've triggered it inadvertently. I've made the right elections. Next year, the year after that, I don't have to worry much about staying here in the UK too long because I'm in this 4-year window.
Correct.
Oh,
now, what I would counsel caution for is that 4-year window starts from the year in which you first trigger tax residency status. So if you accidentally triggered it, but didn't realise that you triggered it, and maybe only 2 years later or a year later or whatever happens to be, it's not the first 4 years in which you are resident, it's the first 4 years from the first in which you were resident. So if you were resident in year 1 but not in year 2, that's still one of your 4 years. Then 3 and 4. So taking that advice early is important.
That person in that example, that person hasn't filed correctly, hasn't made the election, so potentially there's worse consequences. Do we think that HMRC will be forgiving and allow retrospective election? I mean, TBD, I guess, right?
TBD. My gut is no. HMRC is very familiar with the concept of Americans filing in the UK. It's what they've been doing for a very long time. And for anyone who's not in their first 4 years, we're back into the default regime of paying tax in both countries and claiming foreign tax credits. That is the position that arises in those first 4 years, unless you actively designate in your tax return in a timely manner that you don't want UK tax to be paid.
You don't mess this up.
You don't mess these up. There is, though, a second relief that is less talked about, but potentially more impactful, especially for those clients who accidentally trigger tax residency status or maybe just flip over into the UK tax residency rules, which is to rely on relief given under the US-UK double tax treaty. So the UK and the US have this fairly sophisticated double tax treaty, like lots of countries in the kind of Western modern world have, but the UK-US one is a fairly good typical standard model. And by virtue of American citizens being US income taxpayers, US tax residents for income tax purposes already. Under the treaty, an American is in effect always going to be a US tax resident. At least that's what I've always been told. In the UK, once you trigger our UK tax residency rules, then the UK is going to claim you as a tax resident. And we end up in a scenario where both countries will try and claim you as a resident under their domestic rules at the same time. And what the treaty says is, in those circumstances, subject to a test that determines which way the needle goes, one country has the right to tax you as a resident, and the other country must concede, give way, and tax you as a non-resident, notwithstanding you trigger the domestic tax rules in that country. We refer to that status as treaty residency status. So for an American who comes to the UK, spends 91 days of the UK, and that's enough to trigger tax residency status, but they spent the other roughly 270 days of the UK tax year in the US, that is surely enough to make them a US resident under any metric in the US. And if all of their life, their family, their business, their finances, if everything is in the US, then under that treaty tiebreaker test, they're probably going to break in favour of the US. And so notwithstanding that that person has triggered the tax residency rules in the UK, they will be able to claim on their UK tax return to be a US treaty resident, which means for a lot of UK tax purposes, they are no longer a tax resident.
So that person has substantial income from, let's say, retirement accounts. Income tax in the UK is higher than in the US generally, unless you live in New York or California. And although that person is a UK tax resident, because under the treaty tiebreaker rules, they're clearly US. They won't get taxed. They won't get that. The UK won't look to pick up the excess from their pensions.
Correct.
Oh, that's
It's
nice.
quite handy. So the thing that I counsel caution over is, or the two things I counsel caution over. One is that claiming that in 1 year is, for a person who sort of just tips over into the UK tax rules, is hopefully going to be not insurmountable. Doing it a second year and a third year and a fourth year consistently is going to get harder and harder and harder, because the way in which the test works is the first test says, do you have a permanent home in both countries? If you only have a permanent home in the US, then the US is going to win that rule. But if you had a home in the UK, no one wins. It's a score draw, a tie. The next test, which is the one which then people tend to spend the most amount of time on, is called the Centre of Vital Interests test, which says in which country do you have closer economic, political, financial, family ties. And that's almost like a kind of domicile test. And if you're an American...
That is subjective.
Yeah, and so number one, the more time you spend in the UK each year, the more time you continually trigger the UK tax residency rules, the harder the argument it's going to make to HMRC. And I promise you, my centre of vital interest is in the US. And the HMRC goes, yeah, but you've been in the UK for 10 years. Yeah. So number one, it kind of gets harder to kind of claim each year as you go along. But secondly, and you were exactly right in what you said, it's a subjective test. At least once you get beyond the permanent home in both countries, test one, test two.
Maybe you can make a case that a strong case, my centre of vital interest is the US, right? But I've got more family in the UK, way more family.
Yeah. So how do you balance these different competing interests? So what I say to clients is, if you're looking to avoid the consequences of being tax resident, it is better not to trigger the SRT, the Statutory Residency Test in the UK, because that is an objective test that you can clearly plan for in advance. If you don't avoid triggering it, so if you do trigger it, then you might be able to fall back on claiming to be a US treaty resident.
It's like a get out of jail free card, isn't it?
Yeah, it's
get out of jail.
But it's a subject, or maybe you might do a couple of times, but it's a subjective test, and you are in effect inviting HMRC to disagree with you. You are forming a filing position. HMRC has the right to challenge you on it, and if you're going to go into that kind of an argument, better to go into a fight with a sword of the SRT than hide behind the shield. You hide behind the shield if you only have no other option. But if you've got the choice, it's better and clearer not to trigger the tax residency rules in the first place, But if you find yourself inadvertently on the wrong side of that rule, then treaty residency status is something that I would be raising with your tax advisor.
I forgot how good you are with metaphors, which is a very handy skill in client world.
And podcasting.
And podcasting, obviously, yeah, sorry, which is our new profession. Quick, just going back to the 4-year thing, right? I inadvertently trigger tax residency, and I start the 4-year clock ticking, right? 10 years later, I inadvertently trigger it again. I don't get another 4 years. No. So that's
the 4-year rule is applicable to you if you haven't been a UK tax resident, if you haven't triggered the SRT in the previous 10 years. And here is the really important part about when I said being a treaty resident gets you out of most of the consequences of being a UK tax resident. For the purposes of this discussion,
it brings you back into the IHT net as well,
So the two really important places where claiming merely to be a treaty resident of the US won't help you is the clock will keep advancing for that 4-year rule and towards the 10-year rule for IHT. So if you were in theory someone who came to the UK in 2025 but claimed treaty residency status, and let's say hypothetically you successfully claimed it for 6 years, but in year 7 you don't claim it and you are now just taxed as a UK resident, you've already clocked up 6 years towards your 10-year rule for IHT, because those rules operate on, did you trigger the SRT? And if you did, that's a year towards that. So treaty residency status is more about wiping away the consequences of being tax resident rather than actually making you not tax resident. So this is a kind of maybe a third reason why treaty residency status is useful to kind of, control Z to the US audience, undo that. Oops, that was a mistake. I shouldn't have done that. Let's do a do-over for that 1 year. But if you keep doing it, you are going to eventually find yourself falling foul of those thresholds that come further down the line, and that is then where the consequences really start to bite.
And let's just remind people why you want to avoid UK IHT, inheritance tax at all costs.
Because the UK tax allowances for inheritance tax purposes are currently by default £325,000 per person, meaning that if you've been in the UK for more than 10 of the previous 20 years, your worldwide estate will be subject to inheritance tax at 40%, subject only to the £325,000 allowance, and maybe some relief under a different treaty we have with the US.
Worldwide estate, folks. So if you've got 10, $15 million worth of assets in the US that isn't going to get taxed in the US under the estate exemption, or whatever it's called, and you inadvertently become domiciled in the UK through mismanagement of this, or however, the UK are coming after that.
Yeah, so you've got to think as a person coming to the UK, and so to take it kind of right back, and I think I used this example when you and I spoke last, to take the example of the retiree coming back to the UK, maybe they're coming back in their 70s and they're coming back to spend time to be near the kids and the grandkids. They know that they have 10 years of living in the UK consecutively before their US wealth is going to be subject to inheritance tax. Now that's, and I definitely made this point previously, that's really useful in that it's clear. I know that the number for people coming to the UK for the first time has come down from 15 to 10 years, but knowing with absolute certainty it's 10 years is a boon. If you're going to be coming to the UK and sort of spending half the year, those half years will still count as years towards that calculation. The years you spent on a split year basis will still count towards that calculation. The treaty residency years will still count towards that calculation. And so when someone is thinking about whether they want to move to the UK, that is a key part to the analysis to say, okay, am I okay with wasting some of those 10 years on kind of a 6 months each time? Or do I want to try and stay under the statutory residency test? Maybe I can only spend 4 months of the year in the UK. But I know if I spend 4 months of the year in the UK or just under that, I'm never triggering the rules. I'm never starting that 10-year clock. And so maybe for 5 years, I come for only 4 months of the year. And then when I know I really, really want to retire to the UK, then I just say, to heck with it, I don't care, I'll spend as much time as I want. Well, you've sort of just bought yourself an additional 4 years in the UK because you knew you were staying underneath that threshold each year under the SRT. So that, to sort of loop it right back to the beginning, is why watching the tax residency rules is so important for someone coming to the UK, because you can now use those rules to your advantage to plan precisely when you want to be exposed to UK tax on a more sort of worldwide basis. And for those that know how to sort of do that because they've taken proper advice, you can actually spend quite a lot of time in the UK before you ever start worrying about that kind of worldwide inheritance tax exposure.
You know, I've been thinking about this from the perspective of our clients who are mostly Brits or Americans married to Brits. But this whole podcast has been super relevant for American Americans. And I read a New York Times article in the last week or two that said Americans are moving to Britain in record numbers.
Mm-hmm.
So
why do you think I'm in New York this week?
Well, of course, okay, right. Well, this has been a bit of light entertainment for everyone. Getting deep on the SRT and US residency, so I hope everyone's enjoyed it. Remind us, where can people find you?
So again, my name is Aidan Grant. I'm a partner in the tax and estate planning team at Collyer Bristow in London. My email address is aidan.grant@collierbristow.com, or you can find me at www.collierbristow.com.
So I'd say let's go for a beer now, but you've got a better offer, haven't you?
I'm very much a man in demand, I'm afraid, Richard. You were kind enough to come into New York for this, but yes, I'm afraid duty calls.
Excellent. Well, have a great trip. Thank you for coming on with the Brits in America again. 4th time, ladies and gentlemen. There's no one has been on more, other than myself, obviously. So thank you, Aidan. I know we get great feedback on our episodes, and I know people have reached out to you directly. We get lots of interest from this as well. So thanks again, and I'll see you soon.
It's my pleasure, anytime.